Hi, my name's Jordan Marshall and I'm Special Projects Editor at Building Magazine. Thank you so much for joining us today for this webinar entitled What Does the 2023 Economic Outlook Mean for Construction? We've got three great speakers for you today who I'm really delighted to have as part of this conversation. So I'd love to introduce Ben Warbank, BIM Strategy and Partnerships Manager at Trimble Viewpoint, Simon Rawlinson, Partner at Arcadis, and Alan Mullane, Economics Director at Glenigan. So the way today's session is going to run is a little bit different to how we normally do them. We're going to kick things off with a presentation from Alan, who's going to run us through an overview of where the market currently sits and that sort of thing from an economic point of view. And then we're going to get straight into the Q&A. We're going to have a really robust discussion between our panelists, and we'd love you, the audience, to get involved as much as possible. So please send through those questions. We'd love to get as many of them answered while we have this level of expertise open to us. Just another couple of housekeeping points from me. Yes, these sessions are recorded. We're always asked multiple times. Yes, it'll be recorded. Yes, it'll be available on demand. So please just feel free to access that via our websites. And that's about it. So I think we'll start off by handing over to Alan to run us through the overview.
Sure. Thank you, Jordan, and good morning, everybody. What I was going to do really is quickly run through the latest data that we've got here at Glenigan and our current forecasts for the industry over the next year or so. Really to try and set the scene before we sort of go on to look at things in a little bit more depth. Just to kick off, I thought it might be helpful just to run through with the support of a few slides, really, to look at, as I say, what's happening across the construction industry, but also where potentially we see some opportunities and particular challenges over the next sort of 2 years, effectively. Just looking at our latest numbers, perhaps to kick off, we produce on a monthly basis data, really looking across the information that we collect on projects that are starting on site. So this is the value of work that's actually the actual projects themselves that are starting on site each month, and we compile something we call the Glenigan Index, which is a 3-month rolling index of the value of those projects starting on site. So it hopefully gives you a useful lead indicator of where general market conditions are headed, because obviously projects that start now, they will show up in the government's output data over a number of months as those projects gradually progress on site. Unfortunately, the latest data is somewhat disappointing, and I think a lot of that does, to a certain extent, I think is perhaps a bit of a hangover and a fallout from that mini budget we saw last autumn, which I think really did cause a lot of disruption to the wider economy and something of a shock. And we've obviously seen a sharp rise in interest rates in the aftermath of that. Now, the positive perhaps to take from that is that certainly over the last few months, things do seem to have stabilized. There's a bit more political stability that's coming through at the moment, and certainly interest rate expectations have perhaps eased a little bit, although obviously interest rates are a lot higher than they were just sort of a year or so ago. So I think all of that may perhaps, hopefully, as we go through the course of 2023, give us perhaps a little bit of stability and support for construction activity going forward. Nevertheless, I think there's a lot of pressures in there, and we've certainly got that initial sharp drop that we've seen over the winter months. I think perhaps before going to looking at perhaps in a bit more depth into what's happening over the course of this year, it's useful just to reflect back, certainly over the last year or so. And I think the real hallmark of perhaps of 2021 and 2022 perhaps has been materials availability and costs. And we've seen a sort of significant problems with materials availability generally. The chart there I've got on the left is some data we compile for the National Federation of Roofing Contractors, and it's for their survey, and it's just comments on general availability of roofing materials, whether it's getting better or worse. And I think really you can see that obviously it's been a significant problem over the last 2 years, but it does seem to perhaps be at least stabilizing at the moment. And then conversely, across looking at material prices, there's a similar picture there. Well, over the last 2 years, we've seen a really sharp increase in material costs. That's that's obviously feeding through the sort of construction industry in terms of contractors' costs and the cost of building overall. And after the initial sharp upward spike as we came out of the pandemic, things were stabilizing, and we had another upward spike last year, really in the wake of the invasion of Ukraine. But I think certainly towards the end of last year, there does seem to be that prices again do seem to be stabilizing, albeit at actually a much higher level than they obviously were a couple of years ago. So I think in that sense, there's a little bit of from the cost pressure side of things, there's a little bit of stability there. I think the other half of the equation there is labour availability and costs and the cost of skilled labour, and I think that's likely to be a more persistent cost pressure over the next year or so. Okay, so if you look at across the piece and look at our general latest trends, we try and split the development pipeline into sort of two, obviously across different sectors, but also into two price categories. So the green bars you can see there are the value of projects of less than 100 million that have been starting on site, as on a 3-month rolling basis, and the red bar on top of that are really big projects over 100 million or so. The reason we split that is, I think, looking at that, you get a better feel for general market conditions, as you do with the sort of actual number of projects that have been starting on site. And you can see that actually it was weakening during the course of 2022 in terms of the value of work, and then we've seen a sharp fall over the winter months. Conversely, though, if you look across at the actual development pipeline, this is the value of projects that have been securing detailed planning consent. And that has, again, that's tailed off a little bit over the course of second half of last year, perhaps particularly in terms of the number of projects, but it's still, really is quite firm, and it's perhaps at a higher level than it actually was before we went into the pandemic. So from that perspective, there's, I think that's a positive going forward, that if the confidence is there are the projects that can come forward. But I think it's the confidence side of things at the moment that is holding things back. As I say, over the last 2 years, it's perhaps been the supply issues that have been holding back the pace of development, both in terms of materials, but also labour availability, that rising construction costs. And now I think we're facing, partly as a result of that, response to that, but actually because of what's happening in the wider economy, a weakening in demand and also a shift in demand for construction services. And I think that's the interesting thing, is that there's a cyclical change going on there. We have got a weakening in the wider economy, pretty well a flat economic picture. And that clearly is impacting things like residential construction as the housing market cools. Again, conversely, within other areas, though, there's a bit of a shift. If you're looking at industrial and commercial, again, private investments can be dampened, but there's actually some bright spots there, but very much being driven by structural change, still feeding through from that sort of sharp change in the way the industries and the wider economies performed post-pandemic. So we've seen the growth in the demand for logistics space, for example, and also more hybrid working is impacting in the commercial property market, particularly in the demand for office accommodation over the longer term, but also the need to perhaps refurbish and repurpose existing premises in the nearer term. So that's throwing up new opportunities. And then conversely, the other area that we're looking for growth, perhaps over the next year or so, is greater public sector investment in education and health, but also on the civil engineering side, which I think it was a key sort of plank really of the government's wider economic strategy to drive economic growth over the medium term. But I think that's become even more under the spotlight, I think, in the wake of the need for energy security and for greater investment in across the sort of the energy sector to make sure that we've got the generating and a distribution capacity we need, in the wake of the problems we're seeing, and in terms of the fallout from higher energy costs and availability as a result of the war in Ukraine. So hopefully that gives you a good overall scene setting of as I say, sort of 10-minute introduction. But then we can just go in and have a look at any particular sectors or issues in a bit more depth now.
Hi, brilliant. Thank you so much. That's such a great way to kick things off. I've already got plenty of questions flowing in. But to kick things off, I'm going to be a bit selfish and pose one of my own, the benefit of chairing. And that is, so the first question I sort of wanted to put to you guys is the current market position for the sector. The general consensus is a bit stronger than what we would have anticipated 3 months ago. And sort of why is that? Were we overly concerned about potential pressures, or should we still be anticipating tougher times to come? And I don't mind who wants to jump in first. If anyone's got particularly strong views on this one, yeah, sure. Ben, if you want to go, go.
So I think it's pretty obvious why we're a bit better off than we were 3 or 4 months ago, and that's greater certainty. You know, economically, I think we can probably say that both the current government and the opposition are settling around a kind of orthodoxy. You know, it's not about so much about borrow and spend as perhaps it potentially was under Truss. Although I think it's a little bit unfair to look back at the shadow Labour government under McDonnell. That was clearly a spend and make things grow through spending, in particular on infrastructure and so on. But obviously that was very different circumstances a few years ago, very, you know, almost negative inflation rates and borrowing at much cheaper costs than now. So whether that's entirely fair. But I think now, if you look at what Starmer's proposing or what Sunak's proposing, they're not, as far as I can see, at least too far apart. So there's more certainty there. We've got more certainty in terms of energy cost than we had. That seems to be, you know, 3 or 4 months ago, we were really worried about where costs might go, and perhaps things aren't quite as bad as we feared they'd be there. So I think that's a lot better. We've got perhaps a diminishing risk of a trade war. So with Northern Ireland looking as though it's sorting out, and I think again that gives people greater certainty. And you know, while we've had terrible problems with supply chains globally and getting materials, I think again there is more. Things seem to be settling back to a new normal. So all of that is I think stuff that business was rightly worried about, and that perhaps there's more certainty. I think the big uncertainty that's still there is what happens about Ukraine. You know, that could really mess everything up still. But that's my take about why perhaps we're not quite as bad, looking quite as bad as we were even 3 or 4 months ago. I think that people are just thinking, okay, so we now know roughly how things are like. You know, and I'd qualify this by saying, you know, time and time again, I look at, you know, forward economic forecasts, and they're all horrendously accurate as far as I can see. So, you know, it does come down a lot to people's own take on these things. But talking to people in the industry, I feel that they feel more confident that things are at least settled now. So that's my take on it.
I'm going to provide a slightly contrarian point of view, in that I think Alan's data is the kind of pattern that we anticipated seeing, and possibly a little later. And we have to say that I think 2022, considering the headwinds that the construction sector faced, it did remarkably well. If you delve down into the data enough, however, it had to say the bit that surprised on the upside was still the repair and maintenance sector. That grew, I think private housing maintenance grew by 11% or something like that. So it's a really, really buoyant sector. And in many ways, you could say that the savings that were built up during COVID still, sort of kept things going next year. If I think about prospects for 2023, there are two fundamental issues at play, one of which is viability, which is a combination of course, cost of finance and cost of construction. And that is still a big barrier for lots and lots of different industry sectors. There is some suggestion of softening of demand. Classic one would be the sort of Amazon sort of, deciding not to proceed with some of their units, and in some cases pushing those units back into the market. So that sense of some of the things that we've been taking for granted as being very, very significant demand drivers sort of easing off. And then the other one, I'm sort of slight counterfactual to Ben's optimism around the infrastructure sector. And there's two of them. One of them is that inflation has been eating the civil engineering sector's lunch for the last 18 months. Government's made it absolutely clear that there's no more money, not just for the next 2 years, but for the next 5 years thereafter. So the actual pot that's available to invest is shrinking day by day. And the second one, of course, is the planning issues around some of the private sector investment, particularly the energy sector, is utterly gummed up. So the kind of reforms which were announced or at least outlined last week are incredibly important, but they probably introduce more uncertainty from the point of view of getting investment out than any of the kind of stuff going on with Ukraine and such like. It's just a nightmare making things happen. And if you wanted to give an example of that, I think it was Vattenfall this week going back to government saying that actually we need to renegotiate our deal on their sort of contract for difference because they can't get projects in the North Sea now to stack up. So there are some real challenges around what we would have thought have been really certain investments. So it's a tricky time.
Okay, well, I think it's interesting. As I say, I think you can see it in our data at the moment that we've seen a really sharp fall off in the value of projects starting over the winter months, and I think some of that is it's delayed from that fallout we saw with the uncertainty from the mini budget. So, and I think there is more, and as Ben was saying, I think there is a bit more political certainty there and economic certainty, and I think that will help to steady things. That doesn't mean there's not going to still be economic headwinds over the next course of 2023. But I think Ben's right. I think we're perhaps in a better place than we thought we were going to be sort of a few months ago. But there's still some big challenges out there. And as I say, alongside the cyclical side of things, there are still structural changes that are going through. Someone mentioned this sort of on the industrial side, the need for logistics space and how quick, how strong that is. It's been a fantastically fast-growing sector, but it does seem to be coming into a bit of consolidation now. But then conversely, in areas such as on the office, commercial office side of things, with hybrid working and so forth, there does seem to be a reappraisal about how much office space is required over the longer term, but also in the nearer term, actually, let's make sure the office space is going to suit the different ways of working that we're taking forward. So that throws out lots of opportunities for construction. Coming back also on the cost pressure side of things, I think it's you mentioned the civil engineering side. I think it's also, looking at the data from last year, I think it also sort of tempered the flow of things in areas such as education, for example, as well. I think a lot of the public sector bodies were working, had a sort of almost had a set budget, and then everything was coming in sort of 20% more, and there's, oh, what do we do now, sort of thing. So yeah, hopefully that issue can get resolved. How long the government can just say we sort of be King Canute and sort of hold up their hands and say no, the costs have gone up, but we're not going to sort of provide the resources to do it, I don't know.
And perhaps a bit of an example of that is of course the Levelling Up Fund, which has got lots of people probably more frustrated than excited, to be quite honest, considering the amount of effort that went in to put in submissions. And I think the latest data, which was up until about November last year, is so far that only 300 million has actually been spent out of the 4 billion that's been allocated. So you can take one of two things from this, which is either there's an awful lot of money that's got to be spent between now and 2025, April 2025. So that actually means that the public sector, which has lagged quite significantly, will bounce back. Or alternatively, again, going back to the viability point, it's going to prove impossible to spend. And I think is that's a slight paradox between there being money there, but departments just can't spend it for one reason or another, is one of the things that we probably have to deal with over a while. So lots of value engineering, lots of sort of steps to try and make things stack up to get the investment through.
So that point that you just touched on there about value engineering there, Simon, actually leads nicely into one of the questions I've just had come through from our audience. He sort of posed the question, do you think the challenges around viability are going to force the hand of clients to go down a business as usual route, likely to be at the detriment of things like carbon and sustainability goals? Do you think, you know, if the market's a bit tougher, people are going to forego the things that we've been making progress on recently?
I'm going to take. I'll tell you what. I'll take the example of fire safety and staircase and safe escape and stairs. And you can see some clients have been going down that route voluntarily ahead of there being sort of effectively mandatory standards put in place. And they're doing that because they recognise that if they don't, then they are potentially putting their asset at risk. So I'm going to put the positive view there that no, I think clients are now looking long term, but at the same time they're having to do things around phasing, de-scoping, rescheduling to make things actually happen, because we do face a choice between there being no development at all or there being something possibly a little bit different to what had originally been intended. But I think there are a few sort of tunes that can be played to make that work, and some of it probably is an element of de-specification, but you can do that without necessarily threatening some of the fundamentals of performance that the question referred to.
Brilliant. Yep, go Ben. Oh, Ben, you're muted. Could you just unmute yourself?
Sorry.
No worries.
Ironically, we've got building works going on. So there's a little bit of background noise occasionally. I was just going to say, I back what Simon said about there being more long-termism now. And I think in the tech sector, we are still seeing very much people taking, I think, a much more sensible view of asset cost and looking at whole life cost more than necessarily just the capital cost of constructing the asset. So I, it's not perhaps still as great as we'd like it to be, but I think there is much more of an understanding in the industry about the initial cost isn't necessarily the only thing you should be looking at. So it is that long-termism.
I'll just make the oh, Alan.
No, sorry, you mentioned about the business as usual category. I think one of the other aspects to that is how you build, and I think whether you're using sort of modern methods or prefabricate and sort of offsite and things like that to deliver projects. And I think given that the sort of the cost pressure and particularly the availability of site labour, which I think is a consistent pressure and is not going to go away, I think that's going to be continue to be a catalyst for change and perhaps encourage more people to look down that avenue to deliver projects effectively more cost effectively at the end of the day, potentially.
I'm just going to make a quick observation. I think Ben's point about long-term value is a really good one, but it's probably just worthwhile pointing out to the wider audience that one of the effects of increased interest rates is that the long-term value of, say, for example, energy saving is discounted at a higher rate, which means there's less benefit. So in the same way that the tech companies like sort of Google and sort of Tesla and what have you have lost a lot of value as the interest rates have gone up, similarly, those future streams of benefit around life cycle cost and what have you also have gone down. So it's a bit of a tricky one from a point of view of clients having to justify it at the moment. So the question, I think, again, is really well positioned because it recognises that circumstances have changed quite a bit.
Absolutely,
go on. I'd like
You're muted.
Just to pick up on something Alan said as well, which was looking at modern methods of construction, more off-site and so on. And I think there's something we haven't mentioned yet, which is labour shortage and skilled labour shortage. You know, certainly, I think that's one of the things that's driving this continued move towards NMC and more prefabrication. Clearly, you know, today, you know, working on a traditional muddy site isn't necessarily in the cold on a day like today isn't necessarily particularly attractive to our workforce. I think one of the ways, obviously, that we can make jobs more attractive is by taking things off into a more factory-based environment. So I think as I see labour pressures, you know, without freedom of movement in the EU, so this is post 2016 now. You know, I see labour pressures will continue. That source of fantastic cheap trained labour is gone. So I think we'll continue to see those labour costs driving the move to a frankly more modern, more efficient industry. So I think there are some good things here as well as, you know, being problematic things.
Just as a build on that, we're probably going to end up answering one of your questions a little bit early. If you look at the data, and I'm not sure whether we can trust it or not, but there was quite a big improvement in productivity last year in particular. So the labour force remained flat and output increased by about 5%. So something good is happening in the way that we use our labour now. So I think we should take that as a positive because you know, it's taking a while to get sort of offsite to scale, and of course there are lots of different ways of delivering offsite. You know, if you go down, you know, the 7 categories, a lot of it is actually standardized site process. So it looks like that is developing really well, and we should recognize that, encourage people to do it. More the flexible kind of working measures that are being introduced to sort of keep people in the industry as well. So I think that the labour market at the moment is a bit of a success story, and I think we should continue to celebrate it.
So you are right. That is one of the questions that I wanted to ask you guys about. Is the sort of the commentary around both labour and material inflationary pressures, because they've both obviously been hot topics for the sector for a while. And Simon, you've just said there the industry does seem to be coping quite well with the labour side at least. So that was my question essentially: how are global events impacting both, and how is the industry coping? So if you've got I might go back to you in the first instance just to see if there's anything you wanted to add to that, because you've already sort of answered half the question, and then if the others want to come in as they've got thoughts.
So I think Alan showed some good data around the base data around sort of prices falling, but you know it's still 10% or 12, I think 12, 15. So this is still very abnormal levels of inflation. We're coming up to the anniversary now of the really big spike of inflation that took place March, April last year. So structurally, some of this should start to disappear. But if you dig deeper into the data that Alan's showing, there are certain categories, and insulation is a good example of this. It's gone up by 70% in the last 12 months. So there are some categories that are seeing their prices being driven by new factors rather than old factors. So the issues that affected steel are pretty much dissipated. Timber is now cheaper than it was this time last year, but new things coming through. And I think, and I'd agree with Ben's point here about uncertainty, say from Ukraine, is that all you need is another sort of energy related squeeze. Thank you, China, for coming back on stream, and then sort of issues start to sort of come through again. And we shouldn't forget that the energy price cap is going up in the next 3 months in April, because the fundamentals still keep working through in terms of how long-term energy markets have shifted. So we're not out of the woods, but I think there's an awful lot more stability there, which helps manufacturers in particular, I think, to plan, organize themselves and such like. So, have to be very wary, but it's probably not the panic stations we saw 12 months ago.
Absolutely. Alan, Ben, did either of you want to come in on that one?
Yeah, I think Simon's right in terms of the pattern of material costs that we saw. They've seen big sharp increases both in 21 and 23 across the materials, range of materials products as a whole. But that does seem to have even towards the second half of last year in terms of month-for-month previous month increases. It looked like it was stabilizing. As someone says, it's at 10%, but that's going to come down further because the initial sharp increase is going to drop out of the annual figure, but it's going to remain at a high level. It's not necessarily going to fall. Those energy costs are still coming through, and then there's particular areas which are perhaps a bit more problematic.
I'd just add that one of the headwinds that we face, I think, is this volatility in material cost. Yeah, we've got a bit more certainty now, but I think there are still these potential things that could mess things up again. And when we've all actually had an industry that's reasonably busy, we have seen some notable bankruptcies and disappearances. And for me, this has to relate. If you've got, as we had in 2021, timber prices rose in May, June, and July by 55, 65, and 88% month on month. How do you price that? If you've got a job that's maybe going to be on site for 3 years, the difficulty of, and this is a difficulty both for the contractor and the client, of course. The difficulty of coming up with reasonable costs is extreme. And actually, at the tiny end of the market, we see exactly the same thing. We see huge reluctance now to provide any kind of cost.
Absolutely. So we have had a ton of questions coming in, so thank you to our audience. We will try and get through as many of those as we can. But we have had a lot of specific questions about how do you think one sector is going to do, or how do you think another sector is going to do. So I'm actually just going to ask, which sectors are you sort of expecting to perform well? Which are you expecting to perform poorly? And I know we've already touched on some of those in terms of, we mentioned civil engineering and infrastructure and whatnot, but if there's any standouts at either extremity, it'd be great to sort of have a quick rundown on those and sort of why you think they're going to be behaving the way they will be. I realise that was quite a long and convoluted way of asking that question, but sort of a bit of a sector breakdown I think would be greatly appreciated by the audience. If anybody has any particular thoughts that jump to mind straight away, that'd be great.
I don't mind starting. I mean, I sit on the CPA's forecast panel, so sort of reflecting on some of the discussions, I have to say generally the forecast panels, they're quite optimistic actually, rather than being sort of direly pessimistic. But everybody will have noticed that the housing market is probably the one that is going to contribute most to a slowdown in 2023, and that's mostly going to be related to the volume house builders, and that's mostly them choosing to reduce the rate of production on site relative to their sales rates. So if sales rates improve, they'll increase their build rates. So that sector, I think, is, you can almost like sort of leave it to look after itself, because if it sees any signs of improvement, it'll pick up. The one that I'm sort of really quite interested in is the industrial sector. It's obviously split into two parts. You've got the manufacturing bit, and then you've got the logistics bit that's been going absolutely nuts over the last 2 years. And it's difficult to not exaggerate just how explosive that growth is. Secondly, the headwinds that logistics have faced from a point of view of their exposure to inflation, and the headwinds they're now facing from a point of view of actually sort of asset value reductions, from a point of view of valuations. So there's no real sign of it dropping off yet, but I would say that's probably the sector that could face quite a significant slowdown. Also because, of course, these are very fast projects. They tend to be completed quite quickly, and therefore they can switch off. I'll probably leave it at that, to be quite honest, and then I'll leave the rest to Sir Ben and Alan to think about.
Okay, I think I sort of echo Simon's points on both those two sectors. I think the one that I think is particularly interesting is the office market. I've mentioned before that this structural change, but I think there's a number of factors that are driving and shaping that sector at the moment, both sort of long-term issues and more immediate ones. I think near term, I think we've seen quite a lot of refurbishment projects coming forward as people have been sort of reshaping and as we've come out of COVID, looking at their office space requirements, making sure that they're really sort of supporting collaborative working. So when people are in the office, they're engaging with each other, and they can get those real benefits from working together in the office on those days. But it also means potentially they need less overall office space. So again, subletting of existing office accommodation, reducing, so to try and mitigate costs and get rid of excess floor space from tenants and that sort of thing. But then I think there's some longer term drivers as well. Actually, if you need less overall office space, plus you've got that ratcheting up in building regulations and requirements, energy performance certificates and things like that. Again, there's perhaps a reappraisal of actually what do we do with the existing stock? Is it going to be repurposed? Is it going to be upgraded? And I think all of those things, not necessarily during 2023, but going forward, I think this could be an interesting sector for either direct redevelopment and upgrading of office accommodation, or repurposing and feeding into other sectors.
Can I just make a quick build on that? Because Alan, I think you made a really good point on that. And it's also worth noting that we're about 30 years down the line from the great late 1980s office boom. And so there are a lot of what you might describe as very generously specified, but now very tired and very old looking structures that are out there. And of course, we now have a very, very strong sort of embodied carbon regime from the point of view of planning coming in. So I think there's some very strong structural factors that are sort of driving clients towards very, very substantial refurbishments, pretty much a new build around an existing frame. But I think that's a trend that now I think is going to be with us pretty much unbroken now, because we've just got the stock that is coming up. It's developed out the site. What else can you do? So no, it's interesting times.
I'm just going to jump in quickly, just because I've had this come through a few times. Yes, if you want to catch up on any of these facts, if you want to review any of the data from the start, everything will be available on demand via the same link you've joined by just now, in about half an hour after the session ends. So don't fear if you feel like you've missed something, you can rewatch, you can share with a colleague, it'll all be fine. I'm just going to jump into another audience question here, because it's quite an interesting one. About whether actually, Ben, I cut you off. Did you have any sectors that you wanted to flag up there?
Not particularly. I was just going to say that despite Simon's headwinds for civils and infrastructure of planning and inflation, I'm quite optimistic about things remaining quite buoyant and busy in that market. I think we've got large projects like Sizewell C, which are really, you know, these are strategic decisions for the country as a whole, rather than necessarily just led by pure economics. So, I think we are pretty likely to see large projects like that go ahead. Likewise, the grid, the national grid amendments to allow us to get all of that power coming from the North Sea into our grid, they've just got to happen. So yeah, I take the point. You don't think so?
Well, I think I totally agree. They've got to happen, but they haven't even started the planning process for those transmission lines. And if you're not telling me that planning process isn't going to be controversial, these are long-term programs rather than short-term workload. In terms of,
essentially, I agree with all of this, but I can't see that sector can not carry on, because I think we need that. And I guess this is another one. This is, I guess, where my politics come out a bit. I'm slightly left of centre. Yes, housing is facing a rough time at the moment, but if you look at the number of units we're building as a country, it's unbelievably low, and we need a lot of housing. So I cannot see that at some stage, one way or another, government won't step in and build a lot of housing, because it's needed. So again, absolutely right. Housing is one of the disappointing markets at the moment, but I think if we take maybe a slightly longer than this year view, we have to build housing. We're at historically low levels of house building, and we have to do it one way or another.
Okay, we've had quite a few questions come through around potential implications for both contracts and disputes arising from the current market conditions. Are we likely to see contracts looking a bit different, and are we also likely to see a rise in disputes if the market's a bit tougher? Does anyone have any thoughts?
I'll punt in. So firstly, I think post-COVID, both clients, contractors and subcontractors, I think, have recognised that the risk transfer does need to be flexed a little bit to get things to work. And over the last 2 or 3 years, quite a lot of that has been actually about, this is what we need to do to get a project started. So I think there's been some flexibility there, and I think some of those provisions, whether that's sort of granting extensions without cost, maybe some sort of fluctuation clauses, those kind of things, will help to reduce the risk of what would be very obvious disputes on projects. But at the same time, as Ben highlighted in his response around, say, his example of timber, there will be people who have absolutely called to Bath, whether they are main contractors, subcontractors, what have you. So I think there's those elements there. We shouldn't also forget that there are some background issues lurking, particularly around building safety, that that hasn't really started yet. I think it was one of the main contractors, might have been Wilmot Dixon, I think, acted on its pledge to go for its supply chain in connection with failings on some of its projects. And that is something which we're going to have to live with for quite a long time, I'm afraid, and that will engulf a lot of people. But around the current cycle, I would observe that as long as people stay busy, they're probably more interested in securing value from the projects they've got. But the moment they slow down, that creates the time and energy to start investing in some of those claims and such like. So perhaps if we do see a substantial slowdown, we will see a little bit more of an increase in dispute activity as well.
Absolutely. Did anybody else have any thoughts on that one, or should we push along? Because there's plenty of questions both from me and the audience, so we can keep pushing ahead. No?
No,
Cool.
that's fine.
Okay. So Ben, you did briefly mention, you know, it would be remiss not to mention that there has been some, you know, high-profile administrations and collapses recently, notably Toland, obviously, and that's obviously we'll discuss some of the markets that have had challenges, but you know, it has been relatively busy. So, you know, why are we still seeing these like quite high-profile corporate failures if the market isn't, you know, that slow yet? What's sort of driving that?
Well, I think we've actually kind of covered the reasons why that's the case. You know, it is all of the factors relating to material cost, relating to labour shortage and rising labour costs, and commitment, you know, long-term commitment to projects, you know, and a project cost. I think it's inevitable that you're going to get this, and sadly, when somebody like a Toland or, you know, Carillion or whoever goes, it takes a whole vast chunk of the supply chain who they owe money to down with them. You know, it's pretty dreadful. So you know, unfortunately, I think the likelihood is, and Simon will know a lot more about this than I will, but I would think the likelihood is that we will see a few more.
So just put things into perspective. So if you look at the number of you know, sort of, let's call it some business failure events, they are now running at levels that haven't been seen since about 2011, 2012. So they are very high. Now, an explanation for this is that, of course, is that there were protections introduced during the pandemic, which meant that, you know, insolvencies didn't happen at the sort of frequency that they normally did. So there's a whole load of zombie companies who, in the ordinary way of things, would have disappeared during 2020 and 2021 that didn't, and their ultimates of failure has probably contributed to some of the increase that we've seen. But I have to say that was another little step up towards the end of last year, and that is quite worrying from a point of view, because you'd have thought now that, you know, that wave has gone. The number of insolvencies has been falling from about March onwards, and then they start to tick up again. So I do think we probably need to sort of gear ourselves up for the kind of, you know, consequences that Ben's described. And I think he's right. There's an awful lot of stress out there. We need to remember also there's a lot of businesses now that are saddled with these COVID recovery loans as well. So there's a lot going on. Finance costs are going to go up, etc., etc. So yes, it's a difficult situation for organisations to be in.
Well, I think one of the sort of the points we make, picking up on that really, is how do companies respond to make sure they're minimising their exposure. That's the thing to think about, is minimising your exposure, so that you're working. You're confident with the people you're working with, but also you've got a sort of a good basket of organisations that clients you're either working for, if you're subcontractors or main contractors, and also across your supply chain. So if something does happen, you're minimising the repercussions for your own business.
I have to say, this kind of market is one of those markets where the counterfactual around not getting too invested in offsite is something that people need to be careful of, because of course offsite is one of those classic areas of single point of failure. So if you put all of your eggs in the basket of a highly capitalized provider, then, you know, those risks of things going wrong increase. So that sense of the construction's very resilient, very fragmented supply chain sometimes actually plays quite well. And this might be one of those. And I'm not suggesting that people shouldn't be doing offsite, but they just need to be really careful around the kind of businesses that they're dealing with.
Absolutely. Okay. Similar to the sector question that we posed earlier, people have also been asking for sort of like a more regional outlook, particularly in the context of levelling up, and you know, whether like how different regions are anticipated to perform this year and beyond within the UK. Does anybody have any thoughts on that one?
We are anticipating a more of a shift, sort of from the south to the northwards sort of shift, effectively. It's interesting though the point that was made that, you know, there's sort of billions being put into the levelling up fund, for example, but very little of it has been spent yet. So the potential there is for, as I say, for a shift of investment and focus away from perhaps say London and the London economy, which has been to some extent been a worse performing sort of sector or part of the country in some respects. So I think, yeah, I think there was a bit of a shift going on there. I don't know if other people are seeing other things.
If you look at the recent sort of ONS regional data, the area that really surprises on the upside is the southwest. And there recently some quite big public sector orders, hospitals and such like went in there. And of course, you've got the big infrastructure projects. So the southwest looks really pretty good. Eastern region also, for some reason, not quite sure, but that seems to be doing quite well. The ones that look not in great shape are actually, it has to be said, Wales and Scotland. So they're both their orders pipeline and, you know, some levels of activity are you know, not great. And if you think about what's recently happened in Wales with this sort of embargo on their infrastructure program, you know, that from the point of view of the regional construction sector, that is quite a significant slowdown in obviously what previously would have been a quite important part of workload. So it's a bit of a watch out in the sort of the independent or the devolved regions around what the workload looks like.
Absolutely. Okay. So we're rapidly running out of time. I don't know how the hour's flown by this quickly. But I did want to sort of ask, we've obviously touched on a lot of challenges and a lot of positives as well. We've actually had quite a few messages coming through saying they're glad that it's not all doom and gloom, that there's some cause for optimism. But one of the things I did want to ask is, we've touched on offsite, we've touched on a couple of different things. So I was sort of wondering, are there sort of solutions with the digital construction or technological levers that could sort of, you know, be used to help tackle some of the market pressures that the sector is facing? Ben, you're well positioned to speak to this, so maybe if I ask you in the first instance.
So I think that's undoubtedly the case. Actually, I think the tech side of the industry, the construction software providers, haven't done as badly as perhaps we might have feared we would have done through COVID and so on. You know, we certainly saw a big hit as sites stopped briefly, but it was relatively brief compared with other industries. And certainly, while some of the site-based tools suffered with that, a lot of the tools which are more about collaborative working, i.e. working from home, they did pretty well. So actually, you know, not just Trimble, though Trimble did very well. You know, other parts of the software industry have also been reasonably robust. And I'm quite optimistic looking forward. I think most of what I would say about what's happening in the coming year and years with the tech side of the industry would be a continuation of what we've seen. I sit on the government industry interoperability group, and we're just about to launch something again, talking about interoperability, you know, between some of the CDE side of things. I think we're going to see. So Trimble made a big partnership in last October with Microsoft. I think the whole data question, and again, we're looking here about how one actually starts to do really interesting things with all, you know, these enormous amounts of data that we're all collecting. And I think you can only start to do that. I mean, unbelievably, you know, servers are pretty siloed as well. So, you know, there's a big question. So I think it's the big players who are going to drive this area forward. You know, be it, you know, the Oracles or us and Microsoft, you know, beginning to work out how you get data to work more work more freely together. And I think these strategic partnerships are going to be tremendously important as we try and solve what have been issues for, you know, everybody. I know I can almost hear in the background, oh God, not this again. You know, things are really moving in this area, and I can see that this is something where, you know, and I think, you know, we are looking perhaps not just in 2023, though I think we'll start to see some things happening there, but in the years moving forward, where data becomes, you know, much more fluid and much more usable. You know, as we start to look, you know, we're looking at not just actually, so we're in construction, transport, in global location, and agriculture as well, and we're actually looking about, you know, at how we mine this data ocean for the benefit of all of those industries, not just one. So, you know, these are big topics which I think you will see carrying on, and sort of moving forward. So yes, a lot more integration going on in a variety of different ways, and it is a really, you know, while I understand that people are saying, well, yes, you know, but we've talked about interoperability for so long, it is a really hard nut to crack, actually, even within your own, you know, even within all of the many softwares that Trimble own. It's a hard nut to crack, and obviously then we're trying to get a much more fluid connection of data between different parts of the industry as well. So I'm always terribly optimistic. I think that, you know, you know, yeah, I can hear somebody saying, Ben, you said this to me 20 years ago. But I do think, you know, I do see things really starting to move now in that way, and it'd be interesting to hear what Simon and Alan's take on that is.
Well, I think we were talking about labour availability, shortage of labour, and we've got also the demographics of the ageing workforce as well, which is exacerbating that. I think that the digital solution actually can help really drive and bring those cost savings through and tackle some of those shortages. If you're designing out waste, for example, that's going to help control budgets more cost effectively. So I think there's plenty of room for further progress in there. I think it's going to remain a sort of a key area and growth area going forward.
So I'll just wrap up possibly 3 illustrations of how I think various aspects of data management and IT are going to make a difference. Within our business, we're using really light touch, almost like some self-programming tools, things like smart sheets, which really disrupt the way that we access and share data and make it available to people. So that whole sort of like sort of Tableau style sort of, you know, dashboard, I think is a really positive development, and it's really simple and lightweight. The second one, which I think is in development, really critical, around the sort of higher risk residential buildings, that whole sort of information management agenda around the gateways. And if that's not working effectively, the productivity impacts of having to gather all of that information and demonstrate it will be in place is a real problem. And I don't think anybody's really necessarily got their head around that. So, you know, industry collaborating to make that work is very important. And what we are seeing on some of our largest programs, and Lower Thames Crossing is a good example, is we're seeing much more collaboration across the integrated team, the supply chains of delivery contractors around sharing information in real time to support sort of certainty of delivery and outcome of the programs. And that sense of really integrated data structures that move across contractual barriers, I think is a really positive development. So, and again, helping people being more productive by being more responsive to things as they develop. So I think it's a really good outlook, I'd say.
Brilliant. That brings us to the end of the hour. I can't believe how quickly it's gone. I'd love to thank all 3 of you for your time and your expertise. It's been a really valuable session, which we can see from our audience involvement. Sorry to anyone whose questions we didn't get to. There was just so many coming through. There was no way we were going to be able to answer them all off. Hope we've touched on most of the key points for you all, though. Just a couple of housekeeping points from me. Again, yes, you can watch this on demand, share it with your colleagues. In fact, we'd love you to. So it's just the same link that you've signed up with today, but you just sort of need to give it half an hour after the session ends for the video to process. A couple of other quick points from me. We have a survey that pops up straight after you exit this. It will take 30 seconds to fill in. It's just to sort of tell us what areas you want us to explore in these sessions to make sure that we're providing you with the best events, the most informative topics, and exactly what you're looking for. And just one final little promo. We also have our we have a face-to-face event coming up at the Building Centre. It's on the 21st of May, and it's our 21st of March. Sorry, it's our Risk and Regulation Summit. So we've actually, due to popular demand, just been able to add a few more seats to that one. So if you want to, you can register for the waiting list. It'll be a first come, first served basis for those additional spaces. You can access all of that via any of our brand pages. So that's building design or housing today, or our Assemble Media events page. A huge thank you to our speakers again. Huge thank you to the audience. Big thanks to Trimble Viewpoint for making today possible. And that's it from me. Thank you. Goodbye.
Thanks, guys.
Goodbye.